Welcome to The Explainer. If you've been watching the crypto market lately, you've probably felt some serious whiplash. One minute you're feeling like a genius, the next, well, not so much. So today, we're going to try and make some sense of it all.
I mean, we saw prices hit these incredible new highs, only to come crashing down just moments later. It's enough to make anyone's head spin for sure. So what is really going on here? Is this just random, unpredictable chaos, or is there a bigger picture we're missing? I've brought in our expert to help us separate the signal from all this noise.
Thanks for having me. And you're right to ask. That huge drop we all saw, it wasn't random at all. It was actually a chain reaction, and a pretty brutal one at that.
Okay, so let's walk through it. It all started with a big geopolitical announcement about tariffs. That was the first domino. It spooked the market and caused a small dip. But here's the problem. A ton of traders were using borrowed money, leverage, to make bigger bets. So when that price dipped, it triggered a wave of forced selling, which pushed the price down more, triggering even more selling. It was a total financial avalanche.
$19 billion. That number is just staggering. It really makes you wonder if this whole market is just a house of cards. Is there anything solid underneath all of this volatility?
That is the most important question you can ask right now. And believe it or not, when you look past the noise of that crash, you see a completely different story. You see a real foundation being built, and it's being built with big institutional money.
Now check this out, because this is where it gets really interesting. While a lot of everyday investors were, understandably, panicking and selling, a massive $3.2 billion poured into Bitcoin ETFs. This was the second highest week of inflows ever. The so-called smart money was buying when everyone else was scared. And it's not just a Bitcoin story. Ethereum ETFs, which are led by absolute giants like BlackRock, have now blown past $11 billion in total assets. This isn't just a few people speculating anymore. This is Wall Street making a very serious move.
So wait, let me get this straight. While people like me are watching the charts panicking, these huge firms are just buying. They're steadily grabbing more and more. What does that actually mean for the future of all this?
Exactly. In fact, a lot of analysts don't even see what happened as a crash. They see it as a reset. Think of it like shaking out the system. It gets rid of all that excessive risk and those high-leverage bets. It kind of cleans the slate so the market can keep moving up, but on a much more stable foundation.
And you can see just how deep this goes. These big players aren't just buying crypto. They're building the entire financial plumbing for its future. You have BlackRock prepping its funds for stablecoins, Charles Schwab planning to offer crypto trading, and then you have companies like Ripple and Kraken making billion-dollar acquisitions to build out their services. This is serious infrastructure.
Okay, that all sounds incredibly positive. Almost too positive. It can't all be good news, right? What are the risks? What are the big red flags we need to be watching out for? Well, the biggest short-term risk is the exact same thing that caused the flash crash: leverage. All that borrowed money is still sloshing around the system. So while you have this stable base of institutional money coming in, you still have this very risky layer on top that can turn any small dip into one of those violent, cascading price drops. It's really the fuel for the fire.
And there's another really big shift happening. For years, crypto moved in this fairly predictable 4-year cycle, all tied to Bitcoin's code that reduces its new supply. But now, with Wall Street in the mix, that old playbook might be getting thrown out. We're entering a new world where things like global economics, interest rates, and institutional money flows are becoming way more important.
So, if the old rulebook is basically useless now, that creates a ton of uncertainty, doesn't it? How is a regular investor supposed to figure out what to do in this totally new environment?
It definitely adds a layer of complexity. But despite that uncertainty, the consensus among many analysts is still pretty bullish for the medium term. Now, these are just predictions. Nobody has a crystal ball, but you can see that a lot of experts believe there's still a lot of room for growth into early 2026, as long as those positive trends like ETF inflows continue.
Okay, so on one hand, we have these really strong bullish signals. On the other, we have some very real, very scary short-term risks. How do we put this all together? And, this isn't financial advice, but how should we even think about all this?
Expert, I think it comes down to having the right mental framework. First, you just have to accept the chaos. These wild swings aren't a sign that something is broken, they're a feature of a young, growing market. Second, learn to find the signal in the noise. Focus on the real stuff, the institutional adoption, the tech being built, and probably most important, zoom out. Stop obsessing over the daily price action. Think in terms of years, not days or weeks.
That really does put everything into perspective. It feels like this entire landscape is changing faster than ever, which leaves us with a final thought for you to chew on. Thanks for joining us for this explainer.